Hi everyone, welcome to another episode of Frazis Capital podcast. Ellianna, how have you been?
Good, thanks. How have you been, Mike?
Been good. I was just in Melbourne seeing some investors and companies for a couple of days. It's good to get off Sydney every now and then. Seems to we've done a fair bit of travel this year.
I feel like you're always bouncing around. And what are you seeing in the markets right now?
Look, it's really interesting. I mean, it feels red hot. Certainly our stocks are. I think we're up 63% net. But on the broader market isn't actually that crazy bullish, to be honest. I mean, the number of stocks above the 20-day moving average is below 50%. That usually peaks at above 80, when you're close to a market top. CNN's the fear and greed index is kind of middle of the range. All these kind of indicators don't seem to be picking up what it feels like, which it feels like things are red hot. And I think what's happened is anything retail related has been on an absolute tear. And you actually see that in the numbers. So the last month, there was over $100 billion worth of retail buying. So you think about what happened earlier this year, you had institutions selling, all the quants selling. The quants slowly bought back over the last 3 months. Institutions are still behind. They're still not fully allocated. Heavy cash weightings have largely missed the rally, but now it's basically been taken. It's basically a retail market at the moment. So anything retail related, whether it's the kind of thing that captures, the imagination of the market, whether it's Drone Shield in Australia, Palantir in the United States, a host of other companies, they've all had huge performance in the last 6 months. That also includes fast-growing semiconductor companies, which have vastly outpaced, for example, the Nasdaq or the S&P 500 in terms of returns. So it's interesting. I mean, it's not really a profound thing to say, but it could either go two ways. Either the rug gets pulled on retail, or the professional investors that have largely sat out this rally join the quants and the retail investors in being max long. And if that happens, then you could easily have another 3 to 6 months of grinding up. But yeah, it's really interesting. We're at the phase where we're actually kind of selling a lot of things. So we sold some of our fast-growing semiconductor companies. They hit their profit targets, in months. And our more recent buys have been in the healthcare space, which, is coming off a multi-year bear market. It didn't really have the recovery that other sectors did. And there's heaps of opportunity in that space.
Yeah, absolutely. One company that's back in the spotlight that I've been looking at is Grail, as they're about to announce the results of their Pathfinder 2 trial at the ESMO Congress next week, which I think will be really interesting. And I think it's a huge opportunity for their company as a whole. And this is the first time where they'll present this much data. They have just under 36,000 people involved in this trial.
Yeah, I mean, they've kind of pre-released the data on the first two-thirds of the study. So it'd be extremely, and it also, this is the second time they've done a study like this. So the data from the first part of the trial is actually better than the initial. Remember, this is a company, for a bit of background, if you don't know it, this company is trying to do a pan-cancer blood test, which is unusual because most of the companies doing blood tests for cancer are focusing on a specific indication. And even for those that are doing it one indication, it's been a very, very long journey, to get the medical community on board, to get payers on board, to prove that the test doesn't just work. Like, that's the easy part, or relatively easy part. The harder part is actually proving that it leads to an overall better outcome. Um, it's one thing to know that you have cancer, it's another thing to then be treated for it and to have a better outcome. And that's actually the stumbling block. Because people think, well, I'll just get the test, and if I get a positive, then I'll do more tests. But those tests might be a massive needle, like in the middle of your body. They might be quite invasive biopsy, or it might not be definitive, or you might end up on a treatment for a cancer that you wouldn't have caused trouble otherwise. And since until these tests came about, they weren't being detected. There's no way to know if how many of these cancers, would ultimately not end up reducing lifespan. So they're the kind of questions that are really difficult to answer. I mean, it's very reasonable for the medical profession to insist on those answers and to have like a high degree of skepticism, especially when companies like Grail are quite promotional with their marketing. It's actually available now. You can buy the test for 950 US. So they're really targeting people uh, going to their physicians and asking for it. But any kind of promotional stuff around cancer tests kind of winds physicians up because they know that the risk of false positives is really high, and it's very hard. There's a lot of It's only helpful to know if you have cancer as well, if there's a treatment that's actually going to make a significant difference. So there's people doing tests for glioblastoma, for example, and brain cancers where there's not actually an effective treatment. So you might know you have it, but there's not much a doctor can do with that information um, in certain instances. So yeah, it's an interesting one.
Well, about $10 billion has been spent on this company. And what do you think would need to push them to become profitable? And what sort of scheme could they implement for doctors to take on adopting it?
Yeah, to increase adoption. Well, it's probably more than 10 billion has been spent if you include the acquisition when Illumina bought them. Uh, Look, they're doing 35 mil of revenue a quarter, and they're probably losing about 100 a quarter. So you can do the numbers there. They probably need to, all things equal, like multiply their sales several fold. Two things will change that in the near term. And this is a company that's been around for a long time, but it's a really interesting point right now. Um, the first is that data that you referred to, so that should come out. That's the second study they've done. And secondly, they're going for an FDA approval. Now, the FDA approval hopefully reduces some of that physician skepticism and hopefully unlocks reimbursement. It will just begin the process of reimbursement, but there's a good chance then that insurers and payers will be able to pay for the test and reduce the costs. And that could increase adoption as well. Um, but I think the big picture, this is like a $2 billion company, targeting a $100 billion plus market. The screening market is potentially enormous if you could have one test that could cover a lot of different things. And the reality is it's going to be extremely difficult for them to get, it's almost impossible for them to get the data that you need on a rare cancer. Like you might be able to find it, but let's say you screen 100,000 people, if only a handful of people have it, how are you then going to prove over a number of years that they lead to better outcomes when it's exceedingly rare? Does that mean that you shouldn't do the test? Or does that mean, it's a big ask to ask these companies to prove over the long term that they improve survival for all the different cancers that they can test for? So I don't know. I'm kind of on the side that, get the test out there. It's good that they're doing these large tests. Hopefully it gets approved by the FDA, which means it'll be under scrutiny by, the leading key opinion leaders in the space, the smartest people that kind of drive practice. If they green light it, that's a pretty good indication that it's valuable. And yeah, I mean, if people want to do a test to see if they have one of these cancers, I think it's completely reasonable. It's not available in Australia at the moment, but it's something I'd probably do. It's certainly better than doing a colonoscopy for one cancer, some other test for another, all the kinds of horrible things that we subject ourselves to once you hit a certain age and you have to take all these tests. But yeah, it's $2.5 billion market cap now. Actually, it's had a huge rip. So we bought in the 30s, and it's now 70, just under 72. So that was something that our models just gave us a buy signal. We bought, and it's up more than 100%. So that's nice. It's been helpful for the last couple of months.
Yeah, it's an interesting point you made that it feels like a bit of a solution to a problem that just brings up a lot more questions about how it could be useful, what the future of cancer screening in general looks like. But for Grail, considering if everything goes well with the FDA approval and with their trial results, and they have about 600 billion of cash runway right now, what do you think the most realistic timeline for them rolling this out would be on a larger scale to
I
physicians?
mean, to get to profitability, a long time, like many years, likely. And I'd probably spend a lot. These American companies just spend so much, but I guess the salaries there are so high. Um, and there's so many, they'll have to have an immense sales force, all the regulatory people they'll have to hire. These are expensive businesses to run. But this has been a cash burner. Like, this has been burning half a bill for a long time. Before Illumina bought them, they had raised 3 bill US. So there's a good chance by the time this is through, 20 to 25 billion probably will have been spent on this one diagnostic, pan cancer diagnostic, but like on this one product. So it's an enormous investment. It's like that double meaning of the Holy Grail. Like on the one hand, it's the Grail, it's something you really want. It really would change things. If you could catch all the cancers early, obviously they have better survivability if you catch it early, more treatment options. But at the same time, nobody ever found the Holy Grail, did they? So it was just potentially a fool's errand, but I don't think this is a fool's errand. I think this is something, it's very good that somebody's doing it. What else has been catching your fancy? What else have you been looking at?
In the general healthcare space, Clarity closed a $203 million institutional placement at $4.20 a share back in July. What do you think that means for the next couple of months of them? Because Clarity's been a significant position for us for a while.
Yeah, I mean, we participated in that raise. Look, it's good. It means that that funding overhang was gone. It went to a handful of shareholders. It didn't trade particularly well afterwards. It traded below for a while, but now it's back up in high fives. So it's up over 20, comfortably well over 20% from the raise price. They're coming to an interesting position. They've got the head-to-head trial, which should come out any time now. The market is generally pretty optimistic on that, and that will show whether diagnostic has a good chance of taking a decent chunk of the market. It's not part of it's not like a phase 3 trial. It's something that will form a body of evidence that will help convince people to use the test, but it's not like a pivotal registrational trial. But it'll be really interesting to see it head to head, because the two people in the market, Lantheus and Telix, have carefully avoided going head to head. It's broadly assumed by physicians that they're roughly equivalent, with some minor differences, slightly longer half-life in one case. But they never went head to head. And I guess it was too much of a risk for either of them. Firstly, there's no reason to fund the study unless you're going to be convincingly ahead. But secondly, let's say you did a trial and you're just behind, maybe that would cause more harm than good. So the return on any investment on head to head wouldn't be clear, even though obviously for physicians and patients, you want to see that kind of data. So it's a bold move by Clarity. It's the decision to do a head to head is definitely one born of confidence. So you'd only do that if you're really confident on the outcome. It is biotech. There are nasty surprises sometimes, but it would be a surprise if that didn't come out well. The other thing to think about is we're just moving forward in time. This stock peaked, like, I guess it would have been over a year ago, at nearly $9, traded down to $1.50, $1.40, $1.50. And now they're a year closer to 27, 28, when hopefully they'll be getting revenues from one or more products, ideally across diagnostics and therapeutics. So time heals a lot of wounds here. There's another one that, not time heals a lot of wounds, like time works in these companies' favor. Another one we bought recently that also, funnily enough, ripped over 100% was Intellia. And we've been watching that for so many years. This is one of the CRISPR companies, and it peaked at about $200 and went all the way down below 10. So you're talking about 95% plus drawdown, and it basically sold off until earlier this year. So 4 years down. And then our risk models gave us a buy signal. Been following it for a long time, decided to buy, and we've got 100% return. So I think that's where I think we're coming up on the 2-year mark of taking quite a quantitative approach to these stocks. And it's crazy how powerful they can be. You're converting a 90% loss into a 100% gain. So if you took a view on the trial results they just announced over the last week, where the trial results were actually exceptionally good, head of the market, that's what caused the stock. I think it was up over 30% that day, and all the CRISPR plays went up as well. Let's say you formed a view years ago that trial was going to work, because they did have the data. That's completely reasonable analysis that it was going to work and be valuable. You could have dropped 90, 95% and still been down substantially. Kind of like Grail, it loses a lot of money. You're talking about billions of dollars will have been spent on this. Many billions of dollars will have been spent before they get anything into market. But if you take a risk managed approach, instead of losing 90%, you can have that same conviction, watch it drop, and then when you get a buy signal, get a triple-digit return in a relatively short period of time. It's pretty phenomenal. Like when you see this stuff in action, it's crazy. It feels almost like magic. But it's more than that. There's reason. I think what's happening is like information is seeping out one way or another, and then momentum's turning on these stocks at the right times, and it's at the margin. Maybe a few more insiders are buying, or fewer insiders are selling. There's always, Intellia is not the best example because most of that data should be under pretty secure lock and key. But if you think about another company, I guess Byrna reported last night, we could talk about that. Momentum, that sold off 40%, and then momentum turned, and now they've come out with a really strong result. But there would be a lot of people that know that it was going to perform well. You've got all the people in the stores, all their employees. You've got their suppliers. You've got customers. You've got people that are interested in a product perspective that like their range and are optimistic on it. Like all that information kind of seeps out, and that seems to sometimes trigger these changes in momentum before the news comes out. So it's almost like the first indication that something's changed actually happens in the price, which funnily enough would fit in with mainline, economic financial theory, which market participants tend to kind of dismiss. But this is kind of what you'd expect. That information slowly gets out, momentum turns in the stock, and then the results come, and then the stock lifts. So if you can find a quantitative way to pick up on some of those signals early, which seems to be what's happening, it seems to be why we perform so well, given how lucky we seem to be getting when you obey one of these, when you build these quant systems. It's really interesting, and I think it's worked far better for us than anything else. Like since we've implemented it, we've done over 60% a year for the last 2 years. We've had good runs before, but I think our best was we had a multi-year stretch of doing 40% a year. I don't think we've ever compounded at 60% for a couple of years. So yeah, it's an interesting market, but it's like this sort of Damocles on us now, because now we know that retail is max long. We knew that quants had gone max long after July, and remember, you do know the data because these people all trade with brokers who report it. For example, Goldman Sachs will track their hedge fund flows, their mutual fund flows. You generally have really good historic data on who's been buying what. We know the quants are max long, retail's max long, institutions are probably underinvested. There's probably more room for them to invest. You've also seen that like it's the retail stocks that have ripped. The market has performed well this year, but nothing crazy. What has the market done? I think I'm gonna guess it's 15%. Views are up 19. Spiders up 14.5. Yeah, so the S&P 500 is only up 14.5%. It's a good year. It's certainly kind of, I guess it's kind of been doing 15% a year for a number of years now. It's a good year, but it's nothing crazy. But then you look at the kind of growth stocks, and a lot of those are up 100% plus and 200% plus from the lows in April. You can really see the impact of that retail demand in the performance of the stocks. So we know that like at some point these things reverse. It's just a question of what happens. Do the institutional investors pile in, or does retail investors and then the quants sell, and then we get a whole nother round, a whole nother sell-off, and then a reset, and then a chance to rally again? Not sure.
If it would be that, what do you think the timeline for that usually looks like? If that's a pattern that happens in the market, would it be in the next couple of months, the next year?
Yeah, well, I mean, usually these things go from 6 to 18 months, so we're probably 6 months in. So it's probably anywhere now to up to mid next year. A rally could easily continue that far, and you probably do need something. You probably do need a trigger. The everyone was max long in February, sure, but it was the Liberation Day thing which triggered that cascade of selling by all three, by retail, by quants, by professionals. I think you need something. I don't think it's just going to roll on its own, particularly because investment is so high. So companies are all investing in AI. Even Byrna came out and said they're doing some AI advertising thing. Everybody's investing and seeing how they can use agents in their business. People are building out data centers. That data center capex build is going to be enormous. It's pushing up electricity prices and probably land prices around the United States. You've got the wealthiest, highest cash flow generating companies in the world taking on huge amounts of debt to build out this capacity. This is all pretty positive stuff, and I don't see anything that turns that around imminently. Obviously, at some point in the next 3 years, it will reverse, but I think you need something to go wrong, and until something does go wrong, it's probably business as usual. It's actually a fun market to invest in, because this is one of those times where if you get something right, you get rewarded almost instantly. If something reports well, the stocks can be up 20-30%. If a company just grows 50%, the stocks over the last year, there's a good chance the stock's been up, will have formed at least 50%. Sometimes there's markets where companies report well and go down, and they're much harder. This is like business as usual kind of market. So hopefully it lasts. But we've got a plan. We know exactly what we'll do if markets roll over, where we'll close out each position, how we'll react to that. We're in a very different situation to very different strategy to what we're running 4 or 5 years ago.
Right. And circling back to Byrna, they did have a really positive quarter, 28 million revenue, up 35% year over year. But I wanted to talk about how every company has some sort of AI. Do you think it adds any value, or do you think everyone just wants to be involved in it?
It reminds me, I've seen this before. It happens all the time where there's like some new hot thing and everybody adopts the new hot thing, and then does, there was a time when there were random loss-making companies that were saying that were converting themselves into crypto companies of one form and another, and having huge moves in the market. It's like that. It's not as dramatic as that. I think everyone's experimenting. Will a company like Byrna really have some big uplift in sales because of some advertising agent? Highly skeptical. But the investment is real. So for example, we got buy signals across the software space. Software not as bad as healthcare and biotech, but software hadn't really recovered. Only the really best companies were at new highs. Um, we got buys in companies like CrowdStrike and Datadog. So it looks like Datadog's biggest customer now is OpenAI. We're in that investment boom. We're in that investment boom cycle at the moment. Companies like OpenAI are raising huge amounts of money, and that means all their service providers, all the different software suppliers, not to mention all the hardware and land and electricity and water around that's required for data centers. All of that's boom time now, and that spend's going to continue. And those companies driving that spend, the big hyperscalers, they're borrowing money to invest more, and these aren't kind of 3 month plans. These are like multi-year plans. There is multi-year plans, yeah. So we're just in. It's going to be like this until it stops. But you're seeing a lot of people trying to call tops and just get blown out of the water. I mean, we thought things might have rolled a couple of times in the last month or so. Obviously, everything just shot up to new highs. You just can't see it yet. There are some signs that things are getting a bit wild. So it does feel a bit like late 2020. A good example of that is the AMD deal. So they signed a very vague deal with OpenAI to supply them with some chips. And in return, OpenAI gets warrants over 10% of the company. And AMD actually went up. And it's not crazily irrational because it means there will be demand and for the next generation of chips, which is good for AMD. But I mean, they gave away warrants on 10% of the company, again, with terms not completely disclosed. But does that really justify a huge increase in share price? I'm not sure. I do know that anybody who announces a deal like that now is going to see a huge share price increase. But I think those kinds of gains are, it's not the same as when a company grows 40% and then the share price is up 40%, where you can clearly tie the performance to the underlying. These deals are a bit harder. It's a bit more hype involved. And yeah, I mean, like I really like Credo and Astera Labs. These companies growing way over 100%, supplying, cables, things like that. Just niche parts of the data center build out. You're buying hardware companies on 40 times revenue plus. It's pretty hard for them to perform from here. I mean, the reality is these companies dropped 65% early in the year, then tripled or more off the lows, actually more. Um, I think that's probably what will happen next. I think you'll see another big drawdown, and then the valuations will come back in line with fundamentals, and then growth will continue, investment cycle will continue, and you'll get another big rip from them sometime next year. That's kind of how we're seeing things. It's good that the good part is that we've caught this rip. Like I said, we're up 63% now for the year. It would be a pretty painful position if you had to chase this market for whatever reason. Like, you wouldn't want to be piling in desperately looking for growth opportunities now. This is the point where you're sitting on the stuff that you bought significantly lower and scaling out when things hit those 2, 3, 4x return multiples, which is what we're after. That would be best case scenario for us, is rally continues for another month or two, and we can scale out of a lot of our positions and build up cash on the way up rather than building cash on the way down when things hit their sell signals. So yeah, that's what we're seeing.
Sounds good. Why don't we wrap this up then? Thank you so much for having me back, Mike.
Thanks for coming back on, Ellianna. I'll do it again next week.